Right now, silver is doing something that most people are not paying attention to. While the majority of investors remain focused on equities, short-term price moves, and daily headlines, silver has quietly entered a phase that historically appears only during periods of deeper global tension. This is not just another rally, it is a signal forming beneath the surface of the financial system. Over the last sessions, silver prices have surged to levels that few expected so quickly. What makes this move different is not just the speed, but the context. This rally is not driven by speculation alone. It is being fueled by a combination of macro uncertainty, currency, pressure, industrial demand, and growing distrust in long-term financial stability. These forces do not arrive randomly. They build slowly, then express themselves suddenly. Silver has always behaved differently from other assets. It is not purely a safe haven like gold, and it is not purely an industrial commodity like copper. It sits between both worlds. That is why silver often reacts when systems are under strain rather than when optimism is high. When silver begins to move quietly, it usually means something larger is changing in the background. What we are seeing now is a rotation into tangible assets. As confidence in paper assets weakens, capital looks for protection. Gold usually leads this process, but silver follows with greater intensity. Historically, silver does not move first. It waits, it absorbs pressure, and then, when the balance finally shifts, it accelerates. The current environment explains why this is happening. Government debt levels remain elevated across major economies. Fiscal deficits are persistent, interest rates are high, yet purchasing power continues to erode. This combination creates discomfort rather than confidence. Investors may accept volatility in the short term, but over time they begin to question the durability of the system itself. At the same time, geopolitical uncertainty is increasing. Trade relationships are under stress. Strategic resources are being reassessed. Energy security, supply chains, and regional alliances are no longer taken for granted. In this environment, metals with both monetary and industrial importance become increasingly relevant. Silver fits that description perfectly. Another important factor is demand. Silver demand is not slowing. Industrial usage continues to expand, particularly in energy infrastructure, technology, and defense applications. Solar energy alone consumes large amounts of silver, and global investment in renewable energy continues regardless of short-term economic cycles. Electric vehicles, advanced electronics, and medical technologies also rely heavily on silver's unique properties. These are structural demands, not optional ones. While demand continues to grow, supply remains constrained. Silver production has not increased at the same pace. Most silver is mined as a byproduct, meaning supply does not respond quickly to higher prices. New discoveries are limited. Regulatory pressure and operational challenges further restrict output. This creates a situation where even small increases in demand can have outsized effects. Markets often ignore these imbalances until they become impossible to ignore. Prices may remain stable for long periods, then adjust rapidly. This is why silver moves tend to feel sudden, even though the conditions behind them have been building for years. Another reason this rally matters is participation. Investment inflows into silver-related products have increased. Retail and institutional interest is returning at the same time. When investment demand aligns with strong industrial consumption and tight supply, price behavior can change dramatically. This alignment does not happen often. Psychology also plays a critical role. Silver is widely underestimated. Many investors remember its volatility and avoid it. Others dismiss it as too small or too unpredictable. This lack of enthusiasm keeps positioning light. When conditions shift, there is very little resistance to upward movement. That is, when silver becomes explosive. It is important to remain balanced. Silver is volatile by nature. Pullbacks are normal. Corrections can be sharp. Short-term strength in the US dollar or sudden liquidity events can temporarily suppress prices. These moves do not invalidate the broader signal. In fact, they often strengthen it by clearing weak positions. What matters most is the direction of pressure. And right now, pressure is building rather than easing. Financial systems are under strain. Policy flexibility is limited. Trust is fragile. Industrial demand is persistent. Supply is constrained. These are not short-term factors. They are structural. Silver does not respond to headlines. It responds to stress. When stress accumulates quietly, silver begins to whisper. And historically, those whispers come before major shifts in market behavior. This is why the current move deserves attention, not because of where silver is today, but because of what it is beginning to reflect about the system as a whole. The market may not fully recognize it yet, but silver is already responding. In part 1, we uncovered how the global financial system is slowly losing credibility, why currencies are under pressure, and why silver is starting to move before the crisis becomes obvious. But now we need to ask a far more serious question. Is silver being deliberately suppressed? And if so, how long can that suppression last? Because what is happening inside the silver market right now is far more dangerous than most investors realize. The biggest deception in the silver market is something known as paper silver. Paper silver is not real metal. It is not bars. It is not coins. It is a promise. It exists as futures contracts, ETFs, options, and derivatives. Digital claims that say you own silver, even though no physical metal may exist behind them. Here's the shocking truth. For every single ounce of physical silver in the system, there are more than 100 paper claims trading against it. That means the same ounce of silver has been sold again and again to different buyers. It tests like selling the same house to 100 people at the same time and hoping none of them ever ask for the keys. This system only works as long as people don't demand delivery. As long as traders settle in cash, roll contracts forward, and trust the system, everything appears stable. But the moment investors start asking for real metal, the illusion breaks. And that moment is getting closer. So who benefits from keeping silver prices low? Large financial institutions, bullion banks, and governments that depend on confidence in fiat currencies. Because silver is not just a commodity. Silver is a monetary warning signal. When silver rises, it tells the world inflation is real. Currencies are losing value, and central banks are losing control. That's why silver is often smashed down during low liquidity hours, through massive paper sell orders, without any physical metal changing hands. These sudden sell-offs trigger stop losses, shake out retail investors, and create fear. But here's the twist. Every artificial price smash creates more physical demand. While paper silver is unlimited, physical silver is not. Silver is consumed every single day in solar panels, electric vehicles, medical equipment, electronics, and advanced technology. Unlike gold, most silver is used and never recovered. At the same time, mining supply is struggling to keep up. Ore grades are declining. Costs are rising. Political and environmental risks are increasing. This is why physical silver inventories around the world are quietly shrinking. Nowhere is this more dangerous than at the COMEX exchange. COMEX is the center of paper silver trading, but the amount of registered silver metal actually available for delivery has been falling. If even a small percentage of contract holders demand physical delivery, the system faces extreme stress. And when confidence breaks, paper silver collapses. Physical silver reprices violently. Smart money understands this. Big players don't chase headlines. They accumulate quietly when prices are boring and sentiment is weak. We're seeing industrial users lock in long-term supply. Wealthy investors take physical delivery, and institutions position early, before the crowd wakes up. Silver is emotional, volatile, and historically explosive. It stays quiet for years, then moves faster than almost any asset on Earth. When silver finally breaks free, it doesn't move slowly. And when trust in paper markets disappears, price discovery becomes brutal. There are only 3 possible outcomes if suppression fails. Either exchanges force cash settlement, change the rules mid-game, or silver reprices sharply higher to restore balance. None of these outcomes are bearish for physical silver holders. The biggest mistake investors make is assuming tomorrow will look like yesterday. Silver doesn't move when things feel safe. It moves when confidence breaks, and the warning signs are already here. In part 3, we'll explore the 56 and how most retail investors get trapped at the top, because this is the moment where silver stops being theory and becomes reality. Now we arrive at the most important part of this entire story, because this is where silver stops being ignored and starts shocking the world. The question is no longer if silver will move. The real question is how far, how fast, and who will be left behind when it does. Let's start with a breakout trigger. Silver does not rise because of hope. It rises when confidence breaks. Confidence in currencies, confidence in markets, confidence in governance. And right now, that confidence is fragile. Rising debt, endless money printing, geopolitical tension, and trade conflicts are pushing the system to its limits. History shows us something very clear. Silver does not move gradually. It explodes. In past cycles, silver stayed flat for years, then doubled or tripled in a matter of months. When it breaks out, there is no warning. Now let's talk numbers. The first major level is $50 per ounce. This is not a random number. It is psychological. It is historical. Silver has tested this level before. If silver breaks and holds above $50, the narrative changes overnight. Mainstream media starts paying attention. Retail investors rush in. Momentum traders pile on. This is where volatility becomes extreme. But $50 is not the end of the story. It's only the beginning. The next level is $75 per ounce. At this point, something critical happens. Industrial users panic. Manufacturers that rely on silver for solar panels, electronics, and electric vehicles rush to secure supply at any price. Physical shortages become visible, premiums explode, delivery times stretch. Paper prices no longer reflect reality. This is where the disconnect between paper silver and physical silver becomes impossible to ignore. And then comes the number everyone laughs at, $100 per ounce. Right now, it sounds impossible, ridiculous, fantasy. But every historic silver rally was called impossible until it happened. Adjusted for inflation, silver has already traded above this level in the past. What makes this cycle different is demand. Silver is no longer just money. It is technology, green energy, artificial intelligence, defense systems, medical applications. And unlike gold, silver is consumed. Once it's gone, it's gone. Now let's talk about the biggest trap. Most retail investors do not buy silver early. They buy when headlines scream, when prices are vertical, when fear of missing out is strongest. This is where people buy tops. They chase leverage. They buy paper products. They trust the same system that failed them before. Smart investors do the opposite. They position early. They stay patient. They focus on physical ownership, not promises. Because when markets panic, paper claims mean nothing. Only real assets survive. Now here's the most important warning of all. When silver moves, governments intervene. They change rules. They restrict markets. They protect the system. This has happened before, and it will happen again. That's why preparation matters more than prediction. Silver is not about getting rich overnight. It's about protecting purchasing power when confidence collapses. The biggest mistake you can make is waiting for confirmation. By the time silver is safe to buy, the opportunity is already gone. Silver rewards patience and punishes hesitation. We are entering a phase where markets will move faster than logic, where liquidity disappears, where narratives flip overnight. And when that happens, silver will not ask permission. It will reprice violently. The people who understand this story now will not panic later, because when the world realizes what silver really is, there won't be enough metal to go around. Now we move into the phase most people never prepare for. Because when silver starts moving fast, the real danger is not missing the rally. The real danger is reacting emotionally. Markets don't destroy people through crashes alone. They destroy people through confusion. And silver is one of the most confusing assets on Earth. Prices will surge, then crash violently, then surge again. This is how weak hands are shaken out and strong hands are rewarded. Let's talk about volatility. Silver is a small market compared to stocks or bonds. That means when money flows in, prices explode. But when fear hits, prices drop just as fast. This is not manipulation alone. This is structure. Silver has always been volatile because it sits between two worlds. It is both a monetary metal and an industrial commodity. That dual role creates extreme price swings. And that's where most people fail. They panic on drops. They chase on rallies. They sell strength and buy fear. Smart money does the opposite. They expect volatility. They plan for it. They don't confuse price swings with failure. Now let's talk about timing. The biggest obsession. Everyone wants to know, when will silver explode? The truth is uncomfortable. Markets don't move on calendars. They move on stress. Silver doesn't wait for dates. It waits for breaking points. A failed bond auction. A currency shock. A geopolitical escalation. A banking event. One trigger is enough. And when it happens, silver will move faster than news headlines. By the time media explains why silver is up, the move is already over. Now, here's the most misunderstood concept. Silver is not a trade for everyone. If you need fast profits, silver will emotionally destroy you. If you watch prices every hour, you will make mistakes. Silver rewards people who understand cycles, not people who chase excitement. That's why most people enter at the wrong time and exit at the worst possible moment. Let's talk about exit psychology. Most investors say, I'll sell when silver hits a certain price. But when that price arrives, emotions change. Greed replaces logic. Fear of missing more upside takes over. This is how bubbles form. Smart investors define rules early, before emotion enters the room. They understand that no asset goes up forever, not even silver. Now here's something most channels won't tell you. The biggest silver gains often come after the first crash. Silver explodes, crashes hard, shakes out weak holders. Then begins the real move.